There's a great saying that goes something along the lines of, making money is not the same as keeping it. Perhaps you've asked yourself, what can I do in a market crisis? How do I handle the pressure? How can I reduce any unnecessary expenses or increase my savings? Stan Druckenmiller is the founder, CEO, and chairman of the Duquesne family office. He's one of the most successful and legendary investors of all time, with an incredible investing track records across decades and through a variety of market environments. This is a Podfast summary of the conversation between Kiril Sokoloff and Stanley Druckenmiller, discussing the exciting future of investing, where Stanley shares some of his ideas today that will prove sobering, informative, and well-balanced. So sit back and get comfy as we bring you our top 10 key takeaways for the conversation between Kiril Sokoloff and legendary Stanley Druckenmiller. Key takeaway number 1. Stan Druckenmiller's challenging forecasting period. Making economic forecasts in the current period is particularly challenging due to several factors such as uncertainty and volatility, the occurrence of unprecedented events, such as the COVID-19 pandemic, or even behavioral factors like consumer sentiment, investor confidence, and policy decision. Given these challenges, economists and forecasters must employ sophisticated models, robust data analysis techniques, and incorporate scenario planning to mitigate uncertainties and improve the accuracy of economic forecasts. Stan Druckenmiller discusses the challenges of making economic forecasts in the current period. He acknowledges the difficulty of confidently predicting economic outcomes due to factors such as extreme monetary policy, the impact of COVID-19, geopolitical tensions, and global economic reopening. Stan compares this period to previous economic downturns following asset bubbles and low interest rates. He emphasizes the complexity of forecasting in an uncertain environment. Key takeaway number 2. The risks of a hard landing. A hard landing is often accompanied by a rapid decline in asset prices, reduced business activity, and a challenging environment for businesses and individuals. Stan expresses concern about the likelihood of a hard landing in the economy. He points out that the consensus view of a soft landing is unlikely given the prolonged monetary stimulus and the excessive increase in real estate prices. He highlights the vulnerability of retail banks, which have a significant portion of their loans in the commercial real estate sector. Druckenmiller cites lifestyle changes resulting from COVID-19 and higher office vacancy rates as potential triggers for banking problems. Key takeaway number 3. Inflationary or deflationary risks. Sustained increases in prices erode purchasing power due to factors like excessive money supply or rising costs. On the flip side, persistent declines in prices reduce consumer spending due to factors like decreased demand or economic downturns. Ultimately, both impact economic stability. Stan goes on to discuss the potential risks of inflation or deflation. He notes the rapid growth and subsequent shrinkage of the money supply, which complicates the prediction of future inflationary trends. While he previously expected inflation to rise, he now sees the possibility of inflation coming down to the range of 3 to 3.5% in the next 6 to 9 months. Druckenmiller warns of the potential for stagflation if the Federal Reserve fails to effectively address inflation concerns. He also raises the possibility of a burst asset bubble and the challenges of restoring stability in such a scenario. Key takeaway number 4. Implications of monetary stimulus. Monetary stimulus refers to actions taken by central banks to stimulate economic growth by increasing money supply and reducing interest rates. However, excessive or prolonged stimulus can lead to financial imbalances and future risks. Stan explores the implications of massive monetary stimulus and the potential consequences of another round of stimulus. He notes the historic asset bubble and the risks associated with bursting it. He cautions against underestimating the similarities between the current situation and the 2008 financial crisis, emphasizing the potential weaknesses in the banking system. Druckenmiller suggests that housing and certain sectors like biotech and companies benefiting from artificial intelligence, AI, could present opportunities in a hard landing. Key takeaway number 5. The independence of the Federal Reserve. The independence of the Federal Reserve refers to its ability to make monetary policy decisions without interference from the government or other external entities. Stan discusses the independence of the Federal Reserve and the potential risks it faces. He acknowledges that while the Fed's independence will likely survive, there is a higher risk to that independence than he has seen in the past 50 years. He also points out that the Fed's actions in response to a hard landing will play a crucial role in determining the outcome. He also mentions the fiscal challenges facing the country, which further complicate the Fed's ability to navigate the situation. Key takeaway number 6, the point of no return. Being heavily reliant on government and central bank finance can have negative consequences. It can lead to excessive debt, inflationary pressures, and reduced economic freedom. Society is deeply reliant on government and central bank finance due to their roles in providing essential public goods, managing the economy, and stabilizing financial systems. The government and central bank finance make it difficult to escape the clutches of our fiscal situation. Stan explains and expresses concern about the future, comparing it to a scary cocktail of economic challenges. However, he goes on to acknowledge America's history of resilience and sheds some hope for a possible rebound after a potential hard landing. Key takeaway number 7. Navigating tricky markets. Tricky markets allows investors to identify opportunities, manage risks, and potentially generate higher returns. It encourages adaptability, research, and strategic decision-making. In volatile markets, unpredictable nature and potential for significant price fluctuations most certainly occur constantly. Rapid and large-scale price swings can lead to investor panic, erode confidence, and cause substantial financial losses. Stan advises a cautious approach for short hedge funds. He recommends seeking concentrated bets, taking advantage of attractive opportunities, and maintaining an open mind. With the anticipation of a hard landing, it's essential to preserve capital and be prepared for potential future opportunities. Key takeaway number 8, the looming fiscal crisis. The looming fiscal crisis refers to the impending threat posed by unsustainable government debt levels and budget deficits. It raises concerns about the long-term viability of public finances, potential tax burdens, reduced government spending on essential services, and the need for fiscal reforms to avoid severe economic consequences. The United States faces a daunting fiscal situation, with skyrocketing deficits and mounting debt, but Stan emphasizes the urgency of addressing this issue, as entitlements and interest expenses threaten to consume a significant portion of taxes. He goes on to note that failure to act now will have severe economic consequences, squeezing out government and private investments. Key takeaway number 9, the dollar's downfall. There's a significant decline in the value and purchasing power of the US dollar. It results from factors such as inflation, economic instability, excessive debt levels, or loss of confidence in the currency. A weakening dollar can lead to higher import costs, reduced international competitiveness, and diminished trust in the U.S. economy and monetary system. Stan discusses the potential decline of the U.S. dollar and its repercussions. He highlights the weaponization of the dollar as foreign central banks reduce their holdings and geopolitical tensions escalate. The curse of the reserve currency is emphasized, allowing the U.S. to pursue myopic policies without immediate consequences until the privilege eventually fades. Key takeaway number 10, the battle with insolvency. There's an ongoing struggle faced by individuals, businesses, and governments to meet their financial obligations and avoid bankruptcy. The insolvency problem caused by excessive debt and the misallocation of resources is a critical concern. Stan questions whether the government can continue supporting failing entities indefinitely, or if creative destruction and capitalism must be allowed to take effect. While painful in the short term, embracing this approach could revive the economy and restore American values. In summary, despite the challenges outlined, Stan's overall tone remains optimistic and highlights the potential for resilience and rebound. We can be left encouraged by taking proactive measures to address the fiscal crisis, navigate volatile markets, and embrace necessary changes. By acknowledging the looming risks, such as the potential downfall of the US dollar and the battle with insolvency, there is hope for reviving the economy and restoring American values. It is a call for action, emphasizing the importance of making wise choices to shape a brighter future and overcome the current predicament. Thank you for listening to this Podfast summary of the conversation between Kiril Sokoloff and Stanley Druckenmiller, discussing the exciting future of investing. If you enjoyed this content, please like and subscribe. See you next time.